Hello, in Chapter 14 we're going to cover long-term liabilities. These are debts that a corporation can take out in order to finance its activities. Long-term liabilities can take many forms, but they all have one thing in common. For a liability to be classified as long-term, you have to, in order to pay it off in full, take a period of more than 1 year. So a liability is short-term if it's something you plan to pay within the next few months, a bill to a vendor, a utility bill, etc. A long-term liability is anything that's going to take an extended period of time to pay off, and the examples we have listed here are long-term notes payable, a long-term bank loan, mortgages payable, which is a bank loan to secure a specific asset. But there are other things that can go in here as well. Auto loans would count as a long-term liability, and bonds are also a big part of long-term debt for a corporation. Let's start with long-term notes payable. In this journal entry on December 31st, 2018, Smart Touch Learning is going to sign a $20,000 note payable. This note payable is to be repaid in 4 annual payments of $5,000 plus 6% interest each December 31st. So in this schedule, they are making an equal payment towards principal each period, plus on top of that, they have to pay a fee to whoever they borrowed the money from to make it worth that party's while. But in this entry, we're only receiving the cash from initially signing the note and borrowing the funds. So on December 31st, we would denote the fact that we are receiving $20,000 in cash by debiting that account for $20,000. And we would establish the long-term liability on our books by crediting notes payable for that same $20,000. For every piece of long-term debt a company has, there should be a schedule that shows how it is intended to be paid off, when each payment date is going to be, how much that payment is going to be in total, and what portion of that payment is going to go towards principal, actually paying down the debt, and interest, the finance charge the lending institution charges you. Well, for this particular loan that Smart Touch is taking out, their agreement was they're going to pay $5,000 towards principal and 6% interest each and every year. So at the beginning of this loan, on December 31st, 2018, the amount of debt they had, the ending balance of their loan, would be $20,000. During 2019, they would start with a beginning balance of $20,000 because whatever you ended one period with, you have to begin the next period with. So on that beginning balance of $20,000, they are making a payment of $5,000 towards principal plus 6% interest. Well, how do you figure out what the interest charge is? You use the same formula every time. It is your beginning balance times the stated interest rate on the note times the amount of time that has passed. So they're making annual payments here of 6%, and at the beginning of the period, the loan was $20,000. So if you take $20,000 times 0.06 times 1, you come up with $1,200. At the end of 2019, Smart Touch Learning is going to have to pay $1,200 towards their lending institution as a fee for the privilege of borrowing money, and that is in addition to the $5,000 in principal, which means their total payment added together is $6,200. At the end, what will the ending balance of their loan be? Well, that interest doesn't reduce the amount they owe. That's just an extra finance charge. The amount of principal that's remaining on the note is just the beginning balance less the portion of your payment which was applied towards principal. They were $20,000 in debt when 2019 started. In their payments, they paid $5,000 towards principal, which means at the end of the period, they are still going to owe this lending institution an additional $15,000. During 2020, we're going to begin with $15,000 in debt on the books. Again, the ending balance from the prior period becomes the beginning balance during the current period. They're going to make a $5,000 principal payment on this next payment, plus they're going to pay 6% interest again. Well, 6% interest of their beginning balance. So $15,000, which was the beginning balance in 2020, times 0.06, and then times 1 because it's an annual payment, comes out to be $900. So now they're paying $900 in interest in addition to that $5,000 in principal for a total of $5,900. Their ending balance gets reduced only by the portion that goes towards principal. So $15,000 beginning balance minus the $5,000 principal payment brings Smart Touch to an ending balance of $10,000. And they will repeat the same exact process for 2021 and 2022. And at the end of this 4 years, they should have an ending balance of 0, which means they have paid off the loan. As you can see on the chart, each and every subsequent period, their interest expense gets smaller, and this is what they call a descending payment schedule. Each and every period, the amount that is paid towards principal stays exactly the same, but since you're constantly reducing your balance, the amount of interest accrued on your loan that you're going to have to pay off is going to decrease each period, so your payment constantly gets smaller until your debt is eventually paid off. And in total, at the end of this loan that Smart Touch is taking out, they will repay that $20,000 in principal, plus a total of $3,000 in interest charges they got hit with over the 4-year period. So in total, it took them $23,000 to get out of $20,000 worth of debt. Now that we have our amortization schedule set up, we know what our payments are going to be at each date in the future. When we need to record a particular entry, we can just go and reference that amortization schedule to see what our payment is in total and what portion of that payment goes towards principal and what portion goes towards interest. So going back a line here, on December 31st, the very first payment, we know that we're paying $5,000 towards principal. We're paying $1,200 in interest expense for a total payment of $6,200. And that is what this journal entry right here is signifying. Notes payable as a liability decreases on the debit side, so we're going to debit notes payable for the amount that is applied towards principal, which is $5,000. The 6% interest charge they got hit with, it goes into interest expense. It's an expense account, and all expense accounts go up on the debit side. We are paying more in interest expense during the period, so we need to debit that account. We're going to do so for $1,200, and our total payment of cash was $6,200. Cash decreases on the credit side, so we're going to credit cash for $6,200. And the setup of the journal entries is always the same. Anytime you pay off a long-term note, you're always going to have a debit to the note itself for the portion that goes towards principal, a debit that goes to interest expense for whatever amount of interest is accumulated on your note that you're paying off, and a credit to cash for the actual amount of payment, the actual amount that you're transferring to your lending institution to get out of debt. Let's run through another example here, and we'll say that on December 31st, 2018, Paradise Pets has signed a $10,000 note payable. The schedule for this payment is that they're going to make 5 annual payments of $2,000 plus 4% interest each December 31st. So they're making annual payments as well. What's the journal entry for the signing of the note in Paradise Pets? Receipt of cash. Well, they're receiving the cash, so we're going to debit cash for the amount of cash being received, which is $10,000. It's a $10,000 note. Sorry about that. And then we're going to credit the liability to put it on the books, which is notes payable, also for $10,000. When we receive cash in exchange for signing a 5-year note. And then on December 31st, 2019, Paradise Pets is going to have to make its first annual payment of $2,000 plus 4% interest on its notes payable. Well, to figure out how much interest it is, you always take the same formula. Your beginning balance at the beginning of the period times your interest rate times time. This was a $10,000 note. We're making our first payment, which means at the time that interest is being accumulated, we still owe the full $10,000. That's our beginning balance. So we take $10,000, we multiply it by 0.04 or 4%, and since it's an annual payment, we multiply it by 1. And that comes out to be $400. So we're going to get charged $400 in interest. That is in addition to the amount of payment that we're making towards principal, $2,000. So our debits are going to start with a debit to notes payable for the portion that goes towards principal, which is $2,000. A second debit that goes to interest expense that keeps track of the amount that we paid in interest on this particular payment to our lending institution, which is going to be $400. And that means that if we're paying $2,000 towards principal and $400 towards interest, we need to transfer a total of $2,400 in cash to make this payment to the bank. And we paid our annual payment of principal and interest on a notes payable.